Today I'm going to talk about the biggest problem facing Canada's economy right now, and potentially on a dollar volume basis, one of the biggest problems we've ever faced as a nation. And it comes in the form of pre-construction condos in the city of Toronto. If you've been following me for a while, you know that I've been talking about this a lot, but this report from CIBC really has made this a mainstream issue. I'm going to go through the report in which they talk a lot about how pre-construction condos that are closing today are mostly cash flow negative, but they leave out a big part about the equity. So make sure you watch to the end because I'm going to get to that, which is independent research that I've done on the equity positions of a lot of these condos, which from my perspective is the bigger threat. So the report from CIBC Capital Markets here is entitled GTA Condo Investment Challenging Times, and it's by Benjamin Talon, Sean Hildebrand from Urban Nation. I would be remiss to exclude their excellent mention of per capita GDP at the beginning, which is becoming a pressing issue for economists and politicians. I'm going to do a separate video on that I mentioned in regards to the finance minister's comments around how IMF says we're going to have the fastest growing economy. The first chart in this CIBC report shows how GTA new condominium sales have basically fallen off of a cliff. And in order for new condos to be built, we need people to buy them first. So this is going to equate to a big drop in construction. If a project doesn't sell 70% of their units, which they have this line here, if a project doesn't hit that pre-sale target, then a lender typically won't have enough confidence in the project to say, yeah, I'll give you a construction loan to actually start building this. What this equates to is this chart 3 that shows condo construction is dropping quickly in the GTA. And my challenge here is that if this line continues, we will see some major consequences to the construction labor market in 26, 27, when a lot of the projects that should be pre-selling today would be going into construction. There'll be a gap in that construction labor pipeline, and the knock-on effects of that on construction labor in several years will have negative impacts that could last decades. Typically in a situation where somebody who's manufacturing a product, when they're faced with a decrease in demand, they would reduce prices to make it more compelling for people to buy those products. But for a variety of reasons, which I've already outlined on this channel exhaustively, builders literally can't afford to reduce their prices. Their land costs when they purchased were too high. The construction costs are still inflationary and not coming down. Development charges that the municipalities are charging are going up. And as a result of this, because the resale condo market is trending down at a pretty serious clip, the spread between a new unit and a resale unit is pretty high. And so this has made condo investment, pre-construction condo investment, lose its appeal from CIBC's perspective in this report. This has caused a large increase in cash flow negative condos. So when people take possession of these units today, something like 81% of those condos with a mortgage on them would be cash flow negative, which would mean that they're losing money every month. The majority of condos, 58% for 2023 completions, had a mortgage and were cash flow negative. And we saw a huge increase in the cash flow negative positions for newly completed condos in 23 over 22. This is the part where it gets crazy. 30% of these units are cash flow negative by over $1,000. This is a huge drain on the economy, by the way. People who own these rental units are paying money that they would otherwise put into the economy to service the gap between what the rental market is paying for the unit and their actual costs of owning that unit. This is actually like a socialization of affordable housing, by the way. That's a spreading the costs of these units across all of these investors who are making it possible for someone to rent that unit well below the cost of owning that unit. I understand that nobody's weeping for these investors and speculators, and I'm certainly at the top of that list. But with that being said, I think that this presents a very serious challenge for Canada's economy that I expect policymakers to start paying attention to now that this report is out. And here's why I think that is the case. Big five banks hold 75% of the loans that are on these units that we just described. And you can see people are especially incentivized to use big five banks. Your negative cash flow position is not nearly as bad if you're with a big five bank than if you're with a B lender where you're paying a higher interest rate. There are a lot of cases which I've been made aware of by individuals in the industry where banks are actually in positions above 80% loan to value on some of this product, because what happens is the pre-construction unit pre-sold at a value, let's say $1,200 a unit, and the lender will lend based on a loan to purchase price, 80% loan to purchase price. But across the street, there's maybe a 1-year-old condo that is worth, in the resale market today, is trading at $950 or $1,000 per square foot. And that would be very generous. And so the actual fair market value based on the per square foot value of that building across the street has made it so that those lenders that were in an 80% loan to purchase price position on that $1,200 unit that's brand new have now gotten to the point where they're actually above 80% loan to value, which, based on requirements from Basel III and the Bank Act, would necessitate an insurance, CMHC insurance, or some sort of comparable insurance product against risk. And this is where I think the government is going to be forced to step in and actually create some sort of bailout mechanism for this current system. Here's why I think that. I posted some commentary on this on my Substack and LinkedIn as an article that shows basically the pre-construction pipeline and the estimated profit or loss of units that are expected to close this year and over the next several years based on current market values of the resale condo market, not accounting for the fact that the resale condo market is continuing to trend down. And based on this, there are billions of dollars of unrealized losses in the condo pipeline that will be absorbed by retail investors. Again, I understand nobody is weeping for these speculators, and I'm the first person to speak out against this kind of reckless economic behavior. I think that this is very much a fuck around and find out situation for a lot of those condo investors. The problem is that we're in a housing crisis, and any of the units that fail to close will likely sit empty based on how inventory loans work in Canada's real estate market. So as we get through this chart where the majority of condo buildings are closing at negative equity values, people are disincentivized to close. And we're already seeing projects where on closing day, as many as 20% of people are failing to show up and close on those units, not just because they don't want to, but a lot of them can't afford to. And so what happens is those units go back into inventory. The builder takes possession of them, and yeah, they'll keep the deposit and sue the buyer for the difference. But what they typically can't do if they're holding those units in inventory is actually rent them out, because in order for them to be an inventory unit, they need to be a product that is new. It would just be like an inventory loan at a store like Costco where they can't use the product, but they also can't sell the product. There are more resale listings in the condo market than we ever seen in Canada. And the logical conclusion here would be to get them into the rental market. We have a housing crisis apparently in this country, and the government, I think, is beginning to take that seriously. And so we have tens of thousands of units potentially that will end up sitting in inventory, basically bleeding out developers because they'll be paying a mortgage on that, and they can't sell these units into this highly illiquid condo market because they're competing with a record number of listings. And if they had to price discover downwards to drop the prices significantly to sell them for what they would likely transact at in today's market, they would devalue every other owner in the building and piss off all of their buyers. And that would be an absolute mess for them as a builder from a reputation management perspective. They would piss off a lot of buyers, but they would also financially compromise all of those buyers. And this is a sticky situation that everyone is trying to figure out right now. In this article, I basically publicly called for a bailout for this system. And maybe that's a bit of an aggressive term for it, but I think that this will be a necessary policy move that will take place over the next little bit. I don't know which government will do it. I know it's going to be very difficult politically for either government to try and push through a builder bailout, but it will be very quiet and it will be very simple. It would be a CMHC insurance that allows builders to rent out these units, and or a CMHC insurance that allows these units to be held at a loan to purchase price that now has created a loan to value scenario over that 80%. Because from my perspective, a lot of people are watching Canada's banking system right now. Most of the DMs that I get on social media are from global funds that are looking at Canada's market right now, trying to figure out how this whole thing shakes out. And if we have banks, which we've seen in this report, the big five banks scrambling to figure this out because the government isn't doing anything about it, and they're putting themselves in compromising positions and playing in a very gray area of the bank legislations in this country, that could be another layer on top of the already shaky reputation that our banking system is earning globally, with a lot of money laundering challenges over the last couple of years. And I've discussed this money laundering issue at length. I'll try and post a video here, a link to the video here, if you want to watch that one. At the same time, while I think this is a very politically risky move for the government to do, it could also be a big political win, because we're hearing the government going out, they do these press releases. We brought 35 units into the market, 100 units into the market, but this would be tens of thousands of units. And I know a lot of people, like I posted this on Twitter, and, the legendary Steve Suretsky, who's a buddy of mine, said, let it go, the healthy cleansing we all needed. I agree with that objectively, but the challenge is the knock-on effects of this in 26 and 27, when the construction pipeline is completely dry, are going to be massively consequential to Canada's economy, and it would make a problem that can probably be solved in 1 to 2 years into a problem that would take 10 plus years to resolve. So I hope my perspective is clear here. While I don't think that we should be bailing out builders or speculators, and actually in my scenario, the speculators wouldn't really get a bailout, the builders would. I don't think we should be bailing out those groups, but I think that it will likely take place because it's going to be a necessary thing to keep Canada's economy and very much real estate market from imploding. I think the bigger underlying theme here is you should probably not have an economy that depends so much on this product. Like, there are billions and billions of dollars of unrealized losses that are just pulling Canada's economy down right now. And every time they close, that causes a bigger draw on Canada's economy as we get to this cash flow negative position. The best way to solve this problem is to have a more diverse economy in Canada. I think it's become clear that our existing administration isn't going to do that. And so hopefully we see that take place after the next election, but that's a long way from now. And from my perspective, this is a today problem, and it will very much become a much bigger problem in 26, 27 if it's not dealt with today.